So that's where we are. I think this is a very, very important week in terms of the loss of faith in the administration. And not only that, but this will be reflected in loss of faith in the dollar.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for April 22nd through April 29th, 2025, while supplies last. First this week, we feature 1-ounce silver Canadian maples at their lowest premium in years at just $3.49 over spot. Next, 1-ounce Gold Philharmonics are only $65 over spot. 1 10th-ounce Platinum Britannia are just $29 over melt. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Welcome back to Liberty and Finance. We're always glad to have this returning guest, a former bank manager. Alasdair Macleod also has his own Substack where he writes on numerous topics surrounding financial viability for ordinary people so that they can take care of their families' finances now and going forward. Alasdair, thank you for joining us again here on Liberty and Finance.
That's my pleasure.
We always look to your visits here as you give us not only your history of experience in the banking industry, but also your long history understanding the role that gold plays in geopolitics and in the money supply financially, and your European perspective, or I should say your British/European perspective there from your home base in the UK. And we'd like to talk to you about a few topics today, one of which, hard to escape, one elephant in the room, is gold making all-time record highs nominally against the US dollar and most other currencies in the past week. We'll touch on that. Also, would like to talk to you about volatility in the equities market. We've seen some near record up and down days in the last week as well. And you have been studying the apparent retreat by the Trump administration from certain aggressive policies, whether it's tariff policies or policies towards the Fed, and how that will be perceived likely, both domestically and internationally, and what that might spell for the future of the Trump administration and the economic impacts of that worldwide. So, could we start with gold record highs recently, what you've been watching and what you've been observing along that way, anything that we should be looking for going forward?
Yeah, I think the better way to put gold hitting record highs is the dollar's hitting record lows. That's the better way to look at it. And actually, it is extremely important to look at what's going on in that light. Foreigners have been getting out of dollars. That's the whole point. Now, to some extent, they've been moving into sort of portfolio shifts have moved into, say, Eurozone bonds, that sort of thing. But basically, they've just been trying to get out of the dollar. And so that's why gold shot up. It's really, obviously there's, you could argue that gold has risen and all the rest of it, but actually the more accurate definition is the dollar is going down. And the reason I say that is because of the buyers who have been buying gold. Basically they are central banks, sovereign wealth funds perhaps, who basically just want to get the hell out of the dollar. And that's what's been happening. So, the problem really is that, the quantity of dollars in circulation, the amount of dollar credit is absolutely enormous. And it by far outweighs the amount of available gold. So you can understand that the dollar priced in gold is more volatile than, say, the dollar priced in other currencies. And of course, when the dollar goes down, it is the king rat of fiat currencies, so it takes the other currencies with them. So, the Asian central banks in particular don't really have very much appetite for any of our fiat currencies. So you can see why that any dip in gold, anything that comes on offer, they just basically snap up. And that's what's been happening. And the liquidity in the system, of course, has moved over to COMEX from London, Switzerland, and elsewhere. That's where any liquidity is now. But we don't know what's happened to that liquidity. I mean, the stands for delivery are basically accelerated. So as fast as it's coming in through one door, it's going out through the other. Or, I mean, there's a pause, if you like, between them coming in and going out. But you can see that the stands for delivery are enormous. And I suspect that when we see the next stand for delivery, the next contract maturity, and particularly, I think it's the May contract, which is the active one. So end of this month, you could see some huge figures going through. I mean, that's going to be worth watching.
Now, along the way, you mentioned that we really need to examine this as a flight from the dollar, a pivot out of the dollar by global holders of dollars and treasuries. The run-up in the past week especially, but the past 2 weeks in gold has been remarkable. There were several nearly or over $100 moves on a daily basis for about 4 times in a row. Some people would call that, an exhaustion stage of a market, and then there's going to be time for some consolidation and correction, that sort of thing. Just to give us some perspective, because you mentioned in the end that this is a part of a much bigger picture about really a tectonic shift out of what has been the prevailing regime since the establishment of the Bretton Woods standard, et cetera, for the dollar. How far along are we in that process? Do we have any idea how far are we? Are we 5%, 50% or more as far as China, Russia, and other key players divesting of U.S. dollars and U.S. treasuries, as far as a clue of how much more there could be ahead of what we just recently have been seeing?
Well, the only clue we have is the U.S. Treasury's, what are they called, international capital, the tick figures that they produce. So that's always, sort of looking back a little bit, but not terribly far. And if you add up all the components, foreign ownership of financial assets, and we're talking about U.S. treasuries, we're talking about short-term debt, including bank deposits, and we're also talking about corporate bonds, and we're also talking about equities. Total all that up, on the most recent tick figures we have, we're looking at about $39 trillion. So that gives you an idea of just, if, let's just say, the foreigners really do get scared, most of that is going to disappear out of the dollar, and it's going to be so destructive as to be enormous. I mean, it's as simple as that. Now, obviously, there is a bit of a rescue operation going on because, the Treasury understands this. They produce the figures, after all. They can see. I mean, they're not stupid. It's as many commentators seem to think. They can see exactly what's going on. They know the fragility of the situation, which is why Scott Bessent, in particular, has been backtracking on Trump's policies. And I think that Scott Bessent has made it absolutely clear to Trump 2 things. First of all, his tariff policies are going to destroy the economy. And what it'll do is just everybody will be getting the hell out of the dollar. And I think the other thing that he's told Trump is, look, you talking about sacking Jay Powell is the worst thing you can do. You are destabilizing the whole of the financial system. Stop it. I doubt if he's been much less blunt than that. The result is that markets have stabilized. We've seen the price of gold fall, or more correctly, the dollar rally measured in gold. $270 change, really. And of course, any real stuff comes out. I mean, don't worry that the Chinese and the Russians and everybody else will be grabbing it with both hands. So, but basically, we've got a little bit of stability, I think, on the back of that. Everybody relieved that these thoroughly destructive, financially destructive policies of Trump's have been sat on by, if you like, the establishment. Let's put it that way, the permanent establishment. And as to whether this is enough to turn the dollar around and stabilize it, I think not, because remember, there were 2 things which I've been talking about one of which, of course, was the destructive forces of Trump's tariff policies. And the other is the credit bubble. And the credit bubble basically has started to burst. Just look at the equity indices. Look at some of the more ephemeral things like Bitcoin and so on. I mean, okay, Bitcoin are rallying, they've got a bid, but if you like, the markers, if you like, of excess credit have taken a hell of a knock. And while they might rally somewhat, I think that the confidence basically is gone, if you like, upon which credit really depends. So I think that's the first thing. I think the second thing is that if you stand back and you think, okay, we now have an America with a president who we can't really negotiate with because he's effectively being cut out of the loop. I mean, this is really what it boils down to. He's on the run. This art of the deal, forget it. The art of the deal has actually worked against him. So where does this leave a foreigner's idea about the dollar? Does it mean that they're suddenly, oh, thank goodness for that, it's all right, we can go back into the dollar, we don't need to sell any dollars, we can continue to buy US treasuries and all the rest of it, we can continue to invest in equities, whatever. No, I don't think so. I mean, foreigners basically have seen inherently an aggressive and, if you like, an aggressive America against their own interests, against every other nation's interests. They see the backing, if you like, that Trump has had from voters in the recent presidential election. And they can see that while the deep state might be regaining control, it's not necessarily going to be good for international trade relations. We've already seen, I think, quite a lot of damage done to supply chains and things like that. It's destabilized everything. So now what we have is the problem. If you look at the dollar, how are you going to stabilize the dollar? Well, I mean, the best way to stabilize any currency is to raise the interest rates, which we know is not what Mr. Trump wants, but Mr. Trump really has no say in it anymore. So raising interest rates is not something also that the Fed really wants to do, because the economy is already sliding into recession, which basically means that the budget deficit is already going to increase more than previously estimated. And under those circumstances, foreign lenders, if you like, to the US government will understand that the government is in a debt trap, is not escaping from that debt trap, and that's the real issue. I mean, on the tariff side, it may not be quite as bad as the first scares from Trump suggested, but it's still not a good situation. And with the US government in a debt trap, what price their bonds? I mean, the answer basically is that the yields have got to rise, and as the yields rise, the situation for US government finances, federal government finances, get worse. So, where does it end? I mean, the answer is you cannot see an end to rising interest rates under the circumstances which have been triggered to a large extent by Trump's capriciousness over trade. So we're going to have higher interest rates. We're going to have higher bond yields. And there is actually very little that the Fed can do about it. The important point as far as Jay Powell was concerned was he knows he's sitting on a volcano here. And he was, the last thing he wants is to have a president, banging off in the long grass about how terrible he is and how he ought to get interest rates down, trying to undermine him. I mean, that's very, very bad. And I would say that the damage that has been done has not been mended. And I don't think it can be mended. And it's just alerted everybody to the problems, if you like, of dealing with America in the future. I mean, look at BRICS nations. Who are they going to align with? Who are South Korea and Japan going to align with? Look, they do a lot of business with America. Are all the tariffs going to go? We don't know. We can hope that there'll be a sort of, if you like, backing down on the tariffs side. But, this mess I think, convinces everyone outside America, look, you got to have a plan B. You can't rely on these Americans. It's just nonsense. Have a plan B. And the plan B, of course, is to go cozy up to China, because what does China do? China trades, and not only that, but it'll provide you the capital to develop your own economy. What's not to like? So that's where we are. I think this is a very, very important week in terms of the loss of faith in the administration. And not only that, but this will be reflected in loss of faith in the dollar, faith in the credit of the dollar. So one way and another, I can see a small dead cat bounce, maybe. I think that's what we've got at the moment, but dead cats don't bounce too far. And after that, nothing has really changed. So if you like, in the way the press put it, looks like the gold price will continue to rise. The way I'd put it, the dollar is in a bear market and is continuing to be in a bear market.
You mentioned along the way the foreigners waking up to the fact that the U.S. is in a debt trap, and they're watching and they're learning by looking at current unfolding events. What is it that they would actually be watching that it wasn't already there before? I mean, you've explained to us for years this growing, brewing problem, but what is it about the current situation you think that they're still watching that has to do with whether or not the U.S. is in a debt trap that convinces you that they're going to come to an awareness or a change of strategy based on what they're watching unfold right now?
Well, I mean, they know that the U.S. government is in a debt trap. They know that already. But the thing that accentuates it is an economy going into recession, because the tax base, in order to support a higher level of debt, is disintegrating from underneath the debt. And that is, if you like, the classic definition of a debt trap. Everybody knows it. I mean, all the central banks around Asia, they've got departments that look at these things. They know it. And I think, in the past, there has been a fear, if you like, of upsetting the apple cart, of being first to cry wolf, if you like. And I think that that fear has rescinded very, very significantly. I just get the feeling, the fear of being the first one to cry wolf, you're saying, has rescinded. Yeah, well, yeah. The first ones to cry wolf about the real state of affairs with the dollar.
Gotcha.
Because nobody actually wants to topple the whole thing over. It's rather like the Hans Christian Andersen tale of the emperor who had no clothes. And nobody wanted to point out that the guy was naked until some innocent child said, "Oi, the emperor hasn't got any clothes." And that broke the dam. And I think it's, as an analogy, it's not too far away, I think.
You also were talking about the BRICS plus nations coalescing together in a collaborative, cooperative way that builds loyalty, that builds confidence, that builds infrastructure in countries that need it, et cetera, rather than this punitive, blunt instrument approach that's being taken currently by Trump and his policies. What convinces you that there are forces at work within Washington that are muting or perhaps convincing Trump that he's got to retreat or back off? You said that he's losing. He's not the one in control from what you're watching. What convinces you of that?
Well, what convinces me of that, quite simply, is the destruction that he has wrought on markets by, as I said earlier, every time he talks about China, he seems to he says, I'm going to make it 245% tariffs. Hold on, this is a man who actually doesn't understand what, his responsibilities. And not only that, but you have all these executive orders coming out of the White House, which, has he really got the power to do this? You sort of think this is not actually, basically he's doing things that Congress should be doing. I mean, if Congress passed these policies, which I would very much doubt a lot of his policies, that's actually their responsibility, not the president's. He's weaseling around the law to basically take total dictatorship over American policy. and his latest example of this, of course, is on interest rates. He's trying to take it away from the Fed. I mean, this is just so dangerous. And, I think that he has been sat on because quite clearly he's quietened down. And I think he's just been told, look, shut up. When you've now got to ask yourself the question that having sort of embarked on this fairyland idea that he could replace income tax with tariffs and so on and so forth, like they did before the First World War or whatever. What's going to happen now? That's obviously not going to happen. Whether there is going to be any increased revenue from tariffs, we'll have to see. But there's a huge question mark over that. What's going to happen now that he's really given a kick into a recession? He's just kicked the economy downstairs. What's going to happen to the budget deficit? It's going to rise, isn't it? Can he cut taxes? No. If he tries to cut taxes, he'll get punished. It's simple as that. He no longer has the power to do this because I think that Besant and his officials have now got his measure. Trump has basically made the mistakes. He has proved to be totally incompetent in terms of fiscal policy, in terms of economic management, and even politics, I would say. He's just basically bullied his way through. So now that the state is getting Trump's measure, this is not quite so nice. I think the deep state basically is getting back into power, if you like. So we go from Sleepy Joe to Sleepy Trump. I mean, this is going to be, I think, the way it goes. Because, if you start losing, if you're in a position of power, a total power, and you start losing it, because you've made some fundamental errors, basically you're on a downhill slope. In terms of losing that power, you just lose credibility. And the loss of the president's credibility will affect the loss of the dollar's credibility. And as I say, we've got this huge, great credit bubble, the other side of which is debt. And it's debt that everybody's looking at, abroad anyway. And you can see that, if the debt is going to be a problem, which basically means that the cost of debt in the form of interest rates is going to have to rise in order to sustain that debt, as it were, then under those circumstances, what does that do to the economy? The economy starts falling apart because it cannot afford higher interest rates because it's full of zombie corporations. The level of interest, annual interest cost on the federal government is already greater than the entire defense budget. Everything starts going wrong. And this is the problem. And I think it's even too early to say that with the state, if you like, the permanent establishment, helped by people like Scott Bessent, who's actually a pretty sensible guy, trying to sort of calm things down, I don't think it's going to work because we're popping a credit bubble as well as dealing with the trade tariff uncertainty.
You also mentioned in passing that this weakness, as you describe it in Trump's role because of his brash policies, which have had backlash and now may have to retreat from, will be seen as weakness by Russia, by China. Can you elaborate on why you say that?
Well, just put yourself in the Russians' shoes for a start. The Russians, it's all very nice, the idea of having, Trump has actually said, well, I can sort this out in a day. And, okay, realistically, that was never on. But Trump is far closer to coming to some sort of agreement over the Ukraine than the previous administration. I mean, it's as simple as that. But you have to ask yourself, do we really trust this guy? Does he have the support, if you like, to push through these policies? And I think what's been happening recently rather suggests that he no longer has the support within his own organization to really push through these policies. Not only that, but of course, Trump is really looking at effectively dismantling NATO. He doesn't want to continue to paying huge amounts for NATO with other members paying, not very much, or 2% or whatever. And other members of NATO have said, yes, well, we will up our defense expenditure and so on and so forth. Point taken, Mr. President. Yeah, we understand. But I mean, they'll be looking at this and thinking, well, it looks like Trump is getting his comeuppance now. So if we're a bit patient, then we might not have to do all this, because America will probably come back and support NATO. Because if the president's got his comeuppance, I mean, do we actually deal with him? And the latest thing, of course, is that a couple of representatives, I think, talking about Ukraine, I haven't really got on top of the story, were meant to join a meeting, if you like, of leaders in London today, and the Americans have bowed out. They're not attending. The whole thing is in a state of flux. And, Trump loses his credibility. I mean, it happens abroad as well as in America. And so you can see, I think, that we have to rethink the impact on the Ukraine situation. And I suspect that peace, if you like, is moving further and further away.
You also talked just a few moments ago about the impact on the financial future for example, Treasury rate, Treasury bond yield, how that would impact banks. Well, you didn't say this, bank, but that's what I'm going to take you to, because you said there are zombie companies. It'll kick the economy down the stairs, etc. Please talk to us about how you foresee, if that plays out the way you're describing, how that is likely to impact, first of all, the banks, and then we'll talk about other organizations such as insurance companies, pension funds, endowment managements, homeowners associations, hospital and university endowments. So those who are counting on the stability that had been there for the past 40 years. So first of all, what do you see in terms of this impact on those who are shepherding these funds?
First of all, a huge, great bear market in equities. So I think that pension funds in particular, who have been relying on equities for asset growth, are going to have to readjust quite rapidly. So, the old story, I think, of moving, sort of adjusting it from, say, 60% equities, 40% bonds, is probably going to have to go, 80% bonds, 20% equities. But the bonds have got to be short duration. In other words, less than 1 year. I mean, there's no point in having long duration. For a pension fund, there is a, if you like, a sort of special situation for a pension fund, because the pension fund has long-term liabilities. What it wants is to match those liabilities with the maturity of government debt in its portfolio. So it doesn't actually worry too much about price. What it matters is yield. So in that sense, I think pension funds will welcome higher yields. But of course, the problem with high yields is that it destabilizes the whole financial system. So, they're going to have to be quite careful, I think, throughout all this. So that's the first thing. Insurance companies are somewhat different. Basically, an insurance company is a huge, great fund which has two sources of income. The obvious one is premiums. We all know about that. And the other is returns on their investments, which would usually be in the form of dividends or coupons, bond coupons, whatever. They're less interested in, if you like, sort of growth stocks and so on. So that, I think, is almost a simpler case. What they can do is, if they have a problem on the, if you like, the bond side, if let us say the coupon income and so on and so forth drops on the bond side, then they make it up by increasing premiums on insurance policies. So I'm not talking about savings. I'm talking about insuring. I'm talking about the captive insurance business, if you like. in the sense that, an insurance company is insuring you for household goods, fire, that sort of insurance. I'm not talking about the other sort, where you have a policy which pays out on your death or whatever. So they do have these two sources of income. So you tend to get a cycle, if you like, of insurance premiums. They go up and they go down. The other side of it, of course, is what they can make on their investments. So that is going to be an interesting one. I'm not quite sure how that will pan out. My guess is that they will get higher yields, which actuarially will look actually a lot better. Because if let's say you buy the 10-year US Treasury, and the yield at the moment is about 4.5%, if that yield rises to say 5.5%, then you're getting a better return. You would probably hold that to maturity anyway. So you're not going to lose capital value, as it were. Mark to market, yes, but you can run that through. But you welcome the opportunity, rather like a pension fund, of buying 10-year US Treasuries with a high yield. So you don't worry too much about that side of it, because you're there throughout all the cycles and everything else. They've seen these cycles before. This, however, is a very, very big one. So I think it could be a real problem for a lot of insurance companies. So that's the first thing. The other thing is if you're looking at general portfolio management, adjusting things. Everybody's been taught that the way to manage portfolio risk is to change the balance between your bonds and equities. Well, that ain't going to work unless you're sensible enough to actually not have too much duration, because that's where the losses are going to be. And the bonds. I can easily see bond yields rising to over 10%, US Treasury bond yields rising to over 10%. Think what that does to the value of T-bonds. And quite frankly, I can't see how it stops at 10%. So, this is the point about a debt trap. It really is that serious. And as to the pricking of the credit bubble, that basically is going to expose a lot of bad debts in the banking system. It's also, and over leverage, incidentally, too. It will also expose all the zombie corporations in the economy. And I think Jay Powell's going to have his work cut out working with Scott Bessent, to try and, sort of manage some sort of stability in really what's going to be a crisis. Because, the worst possible thing from the point of view of a Keynesian, which is what we have, or neo-Keynesian macroeconomists, is something which they just don't understand. They think that you get a recession, interest rates go down, prices go down. No, they don't. What we're looking at is a recession, and at the same time, rising bond yields, rising interest rates. It's a real killer. And that's the whole point about the biggest credit bubble in history going pop.
You mentioned just now the pressure on zombie corporations in the face of rising interest on their toxic loans and that sort of thing, but the loans are toxic to the lenders, who are the banks. What about the banking stability? You mentioned some are more leveraged than others. Do you have concerns about particular areas of vulnerability in the banking system, and do you see it more in the US or abroad, or is it all connected so it doesn't really matter where the problem might start? It would be a contagion from there.
Well, there are obviously systemic issues, I think, going across all financial markets under these circumstances. The US large banks are not as leveraged as they are in the EU or in Japan. And I think that there has already been a pretty good shift away from lending to small and medium-sized companies into lending to the government in the form of buying T-bills, that sort of thing. That's already, I think, happened to quite an extent. As far as the EU is concerned, I don't have quite the same feeling. I think that they have been starving business of credit. Japan, I haven't got much of a clue on, I must admit. But then, there's just such a huge government bond market in Japan. And I think that's really where so much of the commercial banking obligations are already. And of course, they get undermined by rising interest rates. We've seen a certain amount of disruption there in the past. That seems to have died down for the moment, but I suspect that a lot of that is because a lot of carry trade stuff has been basically washed out of the system by, if you like, the sort of Trump tantrum, the Trump tariff tantrum. The banks are definitely, in both the EU and Japan, are both definitely very highly leveraged. I'm talking about the big ones. And of course, the other thing we've got is we have got the over-the-counter derivatives, and also linked to it very, very much because there's the other side of a lot of risk being laid off. You've got regulated derivatives in the form of futures. Now, I can see that. I think what's happened is that when it comes to gold, the big banks have basically got themselves straight. I mean, notice how they now seem to be quite happy. Their analysts seem to be quite happy, saying, we forecast gold going to $4,000 or whatever it might be. And while I think it would be wrong to say that the analysts are very much in the pockets of the book, I think they would be quite restricted from that sort of comment if it was very much against the interests of the book. So I can only conclude that the big banks have basically got their gold positions straight. What we don't know is whether those gold positions are straight on the basis of paper or actual physical. I suspect quite a lot of it is physical, and I think quite a lot of the gold that migrated from London and Switzerland over the last 2 months into COMEX warehouses is part of that physical build-up, I think, for some of the larger bullion banks. But if we do get a crisis in the precious metal derivatives, then that is going to impact, I think, the entire over-the-counter derivatives system. And there we're talking about potentially trillions. So, yeah, I mean, it's very easy to underestimate. I mean, we've seen the dollar fall on a trade-weighted basis by something like, 10, 11%, I think in April. And that fall, you sort of think, well, okay, so what? But think about the quantity of dollar credit in issue. It is absolutely enormous. The consequences of that 10% fall are very, very substantial. Going from, what the foreigners actually own in terms of financial assets in the US, and on top of that, of course, we also have all the derivatives. I mean, that's absolutely enormous. So this is actually quite a serious situation. And the banks, of course, are the intermediaries in the middle of it.
Alasdair, you write about these topics on a regular basis, and if people want to follow your work continually, how should they do so?
Well, I would encourage anyone to subscribe to my Substack, which is alasdairmacleod.substack.com. The more the merrier.
And folks, if you don't want to miss a single interview with Alasdair here on Liberty and Finance, make sure you're on our free mailing list. Just go to our website, that's libertyandfinance.com. Make sure you put in your email address, click submit, and then confirm on the confirming email. We won't share your email address with anyone. It's completely private. It's completely free, and you'll get one email in your inbox per day with our latest interviews, including all of them with Alasdair and our other guests and any weekly specials. You won't miss a thing. Alasdair, on behalf of all of our viewers and subscribers, thank you for joining us here again on Liberty and Finance.
That's my pleasure, DK.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for April 22nd through April 29th, 2025, while supplies last. First this week we feature 1 ounce silver Canadian maples at their lowest premium in years at just $3.49 over spot. Next, 1 ounce Gold Philharmonics are only $65 over spot. 1 10th ounce Platinum Britannia are just $29 over melt. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.